Okay, let's unpack this. Today, we are diving deep into a company that, operates almost entirely in the shadows of the global economy. Yet its business model has generated absolutely market-beating returns for the better part of 2 decades. We're talking about Judge's Scientific Peril, that's JDG, listed on the London AM market.
JDG is one of the most fascinating niche compounders you will ever encounter. I mean, really, they exist purely to acquire and develop these very specialized scientific instrument companies. They're not trying to build the next iPhone or, the next big pharma drug. They focus on finding and buying the established market leaders in these extremely tiny, highly profitable, fragmented global niches.
Right, and our mission today is to figure out why this exceptional model, this machine for capital allocation, is currently facing such intense scrutiny from the market. We have sources here detailing a really unique discipline strategy that delivered a frankly staggering 21% total revenue compound annual growth rate over 18 years. That kind of compounding success should put them in a valuation bracket reserved for, the titans.
It absolutely should. But that stellar, decades-long track record is now colliding head-on with a pretty acute set of risks. And that's created the central conflict we really need to understand today. On one side, you have these measurable operational difficulties that started in 2024 and have sort of persisted into the first half of 2025. It suggests their core growth engine is sputtering for really the first time in years.
And on the other side, you have this massive, unaddressed internal risk that frankly dwarfs all the others. The key man risk, the impending succession of their 76-year-old founder and CEO, David Securel.
And that combination, the earnings wobble plus the strategic vacuum of leadership change, has just slammed the stock price. It's forced it to trade at a massive discount compared to its high-quality peers. So we are essentially dissecting the anatomy of an exceptional business model that has suddenly found itself at a critical defining crossroads.
Okay, let's start with that operational blueprint, because you really can't appreciate the current troubles without understanding how this machine was built in the first place.
Hmm.
When we look at Judges Scientific, we established it is not a traditional integrated industrial company. So can you define this holding company approach for us?
Yeah, and the difference is it's crucial. A traditional industrial company like, I don't know, a Siemens or a Honeywell, their whole goal is synergy. They want to combine back office functions, standardize manufacturing, integrate R&D across all the divisions. None of that. It is fundamentally a specialist holding company. Its sole purpose is capital allocation and governance, not, and this is key, not operational interference.
So their value creation doesn't come from going in and, aggressively cutting costs or finding efficiencies within the businesses they buy.
Precisely. The core purpose is to acquire, provide financial oversight, and offer patient, long-term support to companies that are already established. They're already profitable, already cash generative in these very specific niche markets. You could almost call them curators of niche excellence. They let the operating companies continue to do what they do best, completely independently.
What allows them to generate those market-beating returns year after year? It has to come down to discipline in that acquisition phase.
It's the absolute cornerstone, the golden rule of the Judges model. They have this rigorous capital discipline, and this is what protects their long-term returns on capital. They have a non-negotiable pricing ceiling.
Yeah.
They aim to buy these companies at a purchase multiple of just 3 to 7 times EBIT.
3 to 7 times EBIT.
Yeah, earnings before interest and taxes.
In a world where private equity funds are often paying, 10, 12, even 15 times EBIT for profitable businesses, how can Judges possibly maintain that pricing discipline? It sounds almost miraculous.
It is the financial miracle of their model. Think about the math for a second. If you're acquiring a business for, let's say, 5 times its operating profit, that means your return on capital in the very first year is 20%. 1 divided by 5. And if you fund that with cheap debt, your return on equity is instantly even higher. They are generating returns far exceeding their cost of capital from day one. The reason they can maintain this discipline, though, that leads us directly into the second and I'd say essential part of the model.
Okay, so we have the price discipline.
Yeah.
But how do they win the bid against a PE firm that's willing to pay twice the price? The source material refers to Judges operating this decentralized federation of niche specialists, currently totaling 25 distinct businesses as of late 2025.
This is where the magic, or you could call it the arbitrage, really happens. When Judges acquires a company, they operate with a very, very light touch. Crucially, the parent company avoids the aggressive integration and, the disruptive cost stripping that founders so often dread. The subsidiaries, they retain their brand name, their local identity, their existing management teams, and all of their operational autonomy.
So they don't replace the CEO with some 20-something MBA grad whose only job is to cut costs and flip the business in 5 years.
Exactly. And this is the ultimate M&A advantage. The businesses Judges targets are typically founder-run, they're highly specialized, and they've often been operating for decades. When those founders finally look to sell, they often prioritize preserving their life's work, the integrity of the brand, the employment of their staff, over extracting the absolute last penny from a purely financial buyer.
So Judges offers them a permanent home.
That's the cultural proposition. That's the pitch. Because of this promise of permanence and operational respect, Judges becomes the buyer of choice. They often win bids or are even invited to bid exclusively precisely because founders know their legacy is going to be protected. And this cultural appeal allows them to maintain that strict 3 to 7 times EBIT pricing discipline, even in really competitive M&A markets. It's a self-reinforcing competitive advantage.
I see. So it's an arbitrage on human emotion and professional legacy built on this foundation of operational non-interference. It's brilliant. Let's take a look at some of the businesses that actually benefit from this model.
Yeah, the portfolio is highly specialized, and it's pretty balanced across 2 main operating segments. Together, they generated $133.6 million in revenue in FY24.
Okay, let's start with the largest half, which is the vacuum segment.
Right, the vacuum segment. It accounts for 52% of their revenue. These are instruments that require a vacuum environment to function. So think extremely high precision, mission-critical equipment used in advanced research. The specialization here is it's profound. A key subsidiary is a company called Quorum Technologies. They're a market leader in sample preparation for electron microscopy. So if you're a scientist needing to look at molecular structures with massive magnification, you absolutely need Quorum's equipment to prepare that sample properly.
And you mentioned another one in neuroscience.
Yes, Scientifica.
Yeah.
They produce this pioneering equipment that's just vital for neuroscience and electrophysiology research. These are businesses supplying the global scientific community. And the margins are high because if a scientist needs a very specific tool for a specific procedure, they can't just switch easily, which means Judges has the pricing power.
Okay, and what about the other segment, material sciences? That's 48% of the revenue.
This side of the business focuses on highly specialized testing and analysis. And a great example of the dominance Judges looks for is a company called Fire Testing Technology, or FTT. They are the world's leading supplier of fire testing instrumentation. Things like cone calorimeters. These are mandatory tools used by regulatory authorities and testing labs all over the world to ensure product safety. Another key player is GDS Instruments. They make these advanced systems for testing the engineering properties of soil and rock, essential for major construction and civil engineering projects.
So across both segments, we're seeing this real focus on niche, high barrier to entry markets. It's all driven by deep technical know-how or regulatory necessity. And it's crucial to remember this isn't just a UK-focused play.
No, far from it. Judges is a serious exporter. They generate over 85% of their revenue outside the UK. This geographic diversification is essential for them. Their key exposures include the rest of Europe, that's 27%, North America at 25%, and China and Hong Kong at 10%. That diversification usually provides a lot of stability, but as we'll discuss later, the recent market weakness has severely tested those geographical assumptions.
Okay, so we've established this core model works brilliantly, built on discipline and decentralization. But every great compounder eventually hits a pivot point. For Judges, that point arrived in 2022 with their largest ever deal, the acquisition of Geotech. Expert, why did this specific acquisition fundamentally change the company's risk profile?
It was a huge strategic pivot because Geotech was not a pure instrument manufacturer. Before this acquisition, Judges was really focused on selling hardware, a predictable, recurring revenue stream from selling instruments. Geotech specializes in high-resolution analysis of geological cores, and critically, it included a substantial services component.
What does that services component actually entail in the real world? Like, what are they doing?
It means they conduct geological coring expeditions. These are large, multi-million-pound contracts. It often involves shipping highly specialized equipment and personnel to really remote locations for months at a time. And this immediately introduced 2 risk factors that Judges had historically avoided: lumpy project-based revenue and a reliance on a small number of large contracts.
Right. Let's put that into conversational terms. If you're selling 1,000 fire testing instruments every year, your revenue is smooth, it's predictable. Now, imagine relying on the timing of one or two massive, complex coring expeditions. If the customer delays the project, say, because of weather or geopolitical issues or just funding delays, that revenue and all the profit with it just vanishes from that fiscal year.
That's precisely what happened in 2024, and that volatility is exactly what the market hates. Predictability equals a premium valuation. By introducing this lumpiness, judges, whether they meant to or not, reduced its operational predictability and increased its risk profile.
And isn't it true that Geotech was also acquired at a multiple slightly outside their sacred 3 to 7 times range?
Yes, that's right. Our sources indicate Geotech was acquired at 7.5 times pre-COVID EBIT. Now, management might have justified this because of Geotech's scale or its unique positioning, but the fact remains, they bent their own strict capital discipline rule for their largest ever deal. This, combined with the new volatile revenue profile, is really the first clear sign that the model's efficiency might be challenged as the company tries to scale.
Okay, moving into section 2, let's frame the broader industry. We know the niches are small, but is the overall scientific instruments market big enough and attractive enough to sustain this acquisition pace?
Oh, it's structurally attractive and massive. The global scientific instruments market is projected to grow at a compound annual growth rate, a CAGR, of about 6-7%. It could be hitting $100 billion pretty soon. So that's robust, steady growth driven by global research demands.
So why aren't they immediately crushed by the giants in the space?
Because of the fragmentation, it's a highly fragmented market. While conglomerates like, say, Thermo Fisher Scientific dominate the multi-billion-dollar high-end mass market spaces, there are literally thousands of these specialized niches where the annual revenue might only be in the tens of millions. Judges deliberately targets the number one or number two player in these niches, the markets that are completely off the radar for the massive players.
So they hunt where the giants won't tread. It's a strategy of avoiding competition by being excellent in areas that are simply too small to justify the attention of a company that's 50 times their size.
Exactly. And that brings up a really critical comparison point. Judges' true strategic peers aren't necessarily the other instrument makers. They are competing for investor capital against other highly successful UK-listed buy-and-build technology acquirers. We're talking about the capital allocation heavyweights like Halmaplake, Diploma PLC, and Spirax Sarco Engineering. Judges belongs in that conversation, which is exactly why the current valuation discount is so provocative.
Let's discuss the durability of this success then. I mean, how durable are these niche businesses? When we talk about their economic moat, it's not one unified defensive wall, is it?
No, not at all. It's highly decentralized, just like their operating model. The sources describe the group's economic moat as the sum of 25 distinct, deep, narrow moats held individually by its subsidiaries. This collective advantage really rests on 4 foundational pillars that just lock customers in.
We already covered the first one, niche dominance. You avoid competition by being number one in a tiny field. Let's move to the second, high switching costs. This is often the best indicator of a quality business.
This is the critical component, it really is. Imagine a government research lab running a fire safety test using an FTT cone calorimeter. They've invested hundreds of thousands into the lab setup, they've trained their staff for years on the specific protocols, and their data is validated by regulatory bodies based on that specific machine. The instrument itself might have only cost them, say, £50,000, which is a tiny component of the lab's massive overall budget.
So if that machine breaks, they can't just plug in some cheap alternative.
Correct. Switching to a new supplier means retraining all the staff. It means rewriting the standard operating procedures. And it could potentially mean having their regulatory certifications delayed or even invalidated. The time, the cost, and the risk of switching are just prohibitively high once a product is specified to that critical customer workflow. The company selling the instrument isn't just selling hardware, they're selling reliability and certainty. And that locks the customer in, often for decades.
And that expertise isn't something you can just easily replicate. Which brings us to the third pillar, technical and regulatory barriers.
This is where the R&D investment comes in. These niche market leaders rely on deep intellectual property and, technical know-how. And what's fascinating, given Judges is this decentralized holding company that doesn't centralize R&D, is the sheer figure. They invested 6.3% of group revenue in 2024 back into research and development.
That is a significant percentage for a holding company. What does that signal?
It signals they are funneling substantial capital back into their subsidiaries to continuously sharpen those individual narrow moats. They're making sure that Quorum Technologies remains the expert in microscopy prep, and FTT remains the expert in fire testing. That R&D spend is like their defense budget. It keeps the barriers high and wards off new entrants who just can't match that level of sustained, specialized investment.
And the final pillar, as we noted earlier, is the M&A model itself, which gives them a competitive advantage in the market for acquisitions. It's an enduring, self-reinforcing advantage.
Right, but we do need to acknowledge the macro environment. Long-term, the drivers are secular. You've got rising global R&D expenditure, increased demand for regulatory compliance, and all the technological advancements in fields like biotech and nanotechnology. These structural trends provide a consistent tailwind.
But the tailwinds don't prevent cyclicality, and Judges has been hit by a very specific type of cycle recently.
That's right. This industry is emphatically not tied to the general industrial economy. It doesn't follow housing starts or manufacturing output directly. Its unique cyclicality makes it highly sensitive to the funding cycles of its core customers.
Who are the core customers that drive this specific cycle?
Universities, major research labs, and critically, government agencies. For example, if the U.S. federal government passes a continuing resolution instead of a full budget, or if political gridlock delays funding approvals for major research grants, that immediately dries up the order intake for companies supplying these specialized scientific instruments.
So delays in Washington directly translate into a decline in orders for a company selling rock testing equipment in the UK.
Precisely. This sensitivity to political funding decisions is the primary driver of their recent challenges, and it ties directly into the weakness they reported in North America in 2025. It's a specialized risk that you wouldn't typically associate with a standard industrial player.
Okay, let's move from the strategy to the scorecard.
Yeah.
Because for 2 decades, the results were, almost flawless. It established a very high benchmark against which these recent struggles have to be measured.
Yeah, the 18-year total revenue CAGR of 21% is a figure that just demands respect. This is proof positive that the decentralized M&A engine was working flawlessly. They were finding great assets at cheap prices and just compounding them aggressively.
And it's not just pure M&A growth. Their long-term organic growth target is 8% CGR. That shows they acquire healthy businesses, and then through patient stewardship and R&D funding, they help them grow further. They're not just consolidating decline.
And the profitability reflected that niche dominance. Adjusted operating margin consistently ran high, peaking at an exceptional 25.6% in 2023. When you have margins that high, it just screams pricing power, low competition, and mission-critical products.
And for income-focused investors, that commitment to the dividend is central to the compounding story.
It's a very clear commitment. They have run a progressive dividend policy, growing at a 22-23% CAGR since 2006. They even enshrined it as official policy. They aim to increase the dividend by a minimum of 10% per year. That level of explicit commitment speaks volumes about management's confidence in their long-term cash generation ability.
Now for the abrupt shift. 2024 was the year the compounding engine hit a speed bump. Management candidly called it a difficult trading year. How hard did this hit the core business?
The financials show a lot of operational leverage. While the headline revenue only declined 1.8%, the core organic revenue decline, which strips out the M&A effects, was a significant 7.6%. Falling from an 8% growth target to a 7.6% decline is a massive, massive swing.
And what was the immediate financial consequence of that 7.6% drop?
Profitability got hammered. The adjusted operating margin contracted sharply by 470 basis points, falling from 25.6% down to 20.9%.
Explain that relationship, because a 7.6% organic revenue drop caused almost a 500 basis point margin drop. That's operational leverage at work, isn't it?
It is. Think of it like a specialized factory. They have high fixed costs, the specialized engineers, the rent on the clean rooms, the R&D budget. When sales volume drops by 7.6%, those fixed costs don't change. And because their fixed costs are a high percentage of their overall cost base, every dollar of lost revenue drops almost straight through to the bottom line as lost profit. This contraction shows that while they are highly profitable, their profits are very sensitive to volume changes.
So what specific factors did management blame for this sudden reversal?
2 non-operational factors are highlighted. First, the geotech delay we mentioned earlier. A single large coring expedition pushed revenue out of the fiscal year, immediately proving that lumpy revenue risk was real. And second, they saw profound weakness in a key export market. China, they reported a general weakness in order intake, with organic orders in the first half of 2024 collapsing by an eye-watering 65%.
Wow, that 65% figure just shows how sensitive their customer base is to geopolitical or, localized economic headwinds.
Absolutely. The diversification they rely on actually became a liability in that specific market for a period of time.
So we fast forward to the interim results for the first half of 2025. The headline suggested a recovery. Revenue up 15%, pre-tax profit up 17%. But the sources tell us management was more cautious, describing a mixed picture. What was masking the underlying truth?
The headline growth was almost entirely an artifact of timing. It was driven overwhelmingly by that geotech coring expedition that was delayed from 2024, finally recognizing its revenue. It was essentially a one-off catch-up that really flattered the results.
Meaning the core weakness in the other 24 businesses persisted.
That's the critical takeaway. And management was transparent about it. They noted reduced profitability in the wider organic group. Interestingly, the China market actually showed signs of recovery. However, a new massive headwind emerged. The primary cause of core weakness was explicitly linked to difficult market conditions in the USA.
And what was the specific diagnosis for the difficulty in the U.S.?
It was traced directly back to reductions in U.S. federal government research funding. This ties back perfectly to that unique cyclicality we discussed earlier. When Congress delays or cuts research budgets, the highly specialized instrument sector feels the pain immediately. The core group is suffering from political funding uncertainty, confirming that their biggest operational risk is external and tied to their government and academic customer base.
Despite all that turbulence, one area of, undeniable strength remains their financial health and cash generation. How did they prove the underlying quality of their earnings during that difficult 2024 year?
Well, the best measure of earnings quality is cash conversion, and Judges just excelled here. In the difficult year of 2024, their cash conversion was an impressive 122%. This means they turned more than 100% of their reported accounting profits into actual cash. It demonstrates exceptional working capital management and proves that the niche businesses are still true cash machines.
And what about the balance sheet? All that M&A activity, even at cheap prices, must require cash. Are they overleveraged?
Not at all. Their balance sheet is strong. Leverage, measured as adjusted net debt to EBITDA, sits low at just 1.5 times. Their bank covenant is 3.0 times, so that gives them substantial headroom. They have the financial capacity to weather the storm, fund R&D, and keep buying. Their capital allocation priorities remain crystal clear. Acquisitions first, then organic R&D, progressive dividends, and finally debt reduction.
Okay, let's debate that dividend signal. Management raised the interim dividend in H1 2025 by exactly 10%. On one hand, it signaled confidence, but isn't raising it by the absolute minimum commitment kind of a nervous signal rather than a resounding one? I mean, they're spending cash they might need for the next big acquisition or to shore up profits.
That's a fair challenge. If they were truly roaring back, you might have expected a 15% or 20% hike, something to signal that things are better than forecast. By raising it by precisely 10%, I think they're communicating two things at once. First, confidence in the long-term cash profile. They are not breaking their 18-year progressive track record. But second, prudence. They're acknowledging the U.S. funding headwind is real and persistent, and they're conserving flexibility. Given the operational difficulties, I think maintaining that minimum commitment is actually a pretty strong signal of conviction that these headwinds are temporary and cyclical, not structural.
Okay, let's get into the critical debate here. We've established Judges has this historically excellent model, but that model is now struggling to scale efficiently. And the central quantitative evidence for this concern lies in their key performance indicator, return on total invested capital, or ROTIC.
This metric, ROTIC, is management's most important KPI. Their medium-term target for it is 30%. And when you look at the trend here, it provides the strongest evidence for the bear case regarding scalability. We saw a sharp and frankly concerning deterioration, falling dramatically from 22.7% in 2023 to a painful 16.5% in 2024.
That is a colossal 620 basis point drop in just 1 year. That's not a marginal decline. That's a systemic challenge being priced into the business.
Yeah.
So what is the analysis linking that ROTIC decline to the concept of scalability?
It connects directly to the geotech acquisition and the higher price they paid. Remember, their success relied on acquiring businesses at 3.7 times EBIT, which translated to these high immediate returns, 20-33% pre-financing. As the company's gotten bigger, they need bigger deals to move the needle. But when you start doing bigger deals, you attract more competition and you're forced to pay a higher multiple, which is exactly what happened with geotech, acquired at 7.5 times EBIT.
So acquiring a business at 7.5 times EBIT just mathematically reduces the initial ROIC compared to one acquired at 4 times EBIT. As they are forced to do these larger, slightly more expensive deals just to sustain growth, the average return on the total capital deployed by the group naturally declines.
That's the core mechanic. If the engine requires ever more capital for ever lower returns, the compounding power just weakens. Until that ROIC stabilizes and recovers toward their, say, 20% historical average, it remains the central quantitative challenge to the scalability of the M&A model. The market is asking, is the golden era of cheap, high-return acquisitions over?
Despite that ROIC warning sign in the difficult 2024, the M&A function didn't cease entirely, which suggests the pipeline is still active.
It was active and disciplined. They completed 3 smaller, synergistic, bolt-on acquisitions in 2024. For example, they acquired a company called Rockwash Geodata, which is synergistic with geotech. That shows they're actively strengthening their existing platforms.
And as we noted, they have serious financial capacity right now.
Massive firepower. They successfully amended and extended their banking facilities to $140 million, and with leveraged at only 1.5 times, they have plenty of debt capacity to execute multi-million-pound acquisitions without stress. But what speaks loudest to their discipline, I think, is the complete lack of activity in the first half of 2025.
0 acquisitions in H1 2025. Why?
Because they stated they continue to apply strict M&A criteria. This tells us that despite the pressure from the market to show growth pressure that's exacerbated by the organic decline, they refuse to panic and overpay. This financial restraint in the face of all that growth pressure is a testament to the enduring culture established by the current CEO.
Let's bring this analysis back to the share price. The stock has undergone a severe derating, falling approximately 47% from its 52-week high. It reflects the earnings decline and the deep-seated risk we've discussed. When you look at Judges Scientific compared to its high-quality UK compounder peers, the valuation gap is, well, it's stark.
It's the defining financial feature of the business right now. Let's just look at the multiple the market is willing to pay for these high-quality, growth-through acquisition companies, specifically using the enterprise value to EBITDA ratio, based on trailing 12 months data.
Okay, so Halma, often considered the gold standard of UK compounders, trades at
24.8 times EBITDA. The market assigns them a massive premium for their size, their quality, and their extreme predictability.
Diploma, another excellent capital allocator in the industrial space.
23.1 times EBITDA. Again, a premium valuation.
And Judges Scientific, the long-term 21% CGR machine, currently sits at
13.4 times EBITDA.
That is a staggering 40 to 50% discount relative to companies that run a similar capital allocation playbook. The market is saying these risks are real, and they demand a massive penalty.
Well, that discount isn't irrational. It's the market pricing in reality. The penalty stems from a cluster of factors that differentiate Judges from its larger, more established peers.
First, there's the obvious factor of size.
Yes, Judges is a small-cap stock with a market cap of around $365 million. Halma and Diploma are institutional behemoths, 15 to 35 times larger. That difference in size and liquidity just warrants an inherent discount.
And second is the loss of predictability caused by that geotech pivot.
The market pays a high premium for smooth, predictable, recurring earnings streams. Halma exemplifies this smoothness. Judges sacrificed a measure of that consistency by introducing the lumpy, project-based geotech revenue. The fact that the entire 2024 miss was driven by a single delayed project is proof enough for the market that they are now vulnerable to these high-impact, low-frequency events.
And third, the fundamental skepticism driven by the erotic decline.
The quantitative evidence suggests the high-return model is struggling to scale efficiently. Until that erotic trend reverses, investors will look at that decline and conclude that Judges might be running out of easy, cheap, high-quality targets. They're effectively paying a discount for the uncertainty around the long-term sustainability of the acquisition model at this larger scale.
And finally, the topic we have saved for its necessary narrative weight. The single largest non-financial risk. We must now address the paramount risk factor. Everything we have discussed, the 3-7 times EBIT discipline, the permanent home culture, the transparency, it was all established by one person who remains at the helm at 76 years old.
This is the single greatest risk factor, and the source material accurately describes it as the key overhang that prevents the valuation from catching up to its peers. Founder and CEO David Securel is the spiritual and strategic architect of the entire operation. He dictates the M&A strategy, he embodies the decentralized culture, and he personally vets the deals.
And he also has skin in the game, owning 9.2% of the company. When a founder with that level of history, strategic importance, and shareholding eventually departs, it just creates a massive vacuum. Why is this succession so much riskier than a typical CEO change?
Because it's impossible to separate the culture from the man. He is the guardian of the discipline. If his successor pivots away from the 3-7 times EBIT rule or attempts to aggressively integrate the subsidiaries, thus destroying the prominent home appeal, the entire source of their competitive M&A advantage just evaporates. The risk isn't just strategic drift, it's cultural destruction.
And this risk is amplified because it's not just a single transition.
Correct. The entire senior leadership is transitioning at the same time. The founding chairman retired in 2025, and the chief operating officer, who handles much of the operational stability, announced his intention to retire by September 2026. This isn't a staggered transition, it's a potential generational changing of the guard occurring all at once, without a clear, named, publicly accepted successor in place. That lack of clarity is exactly what the market fears most.
To balance the succession risk, though, we should acknowledge the proven quality of the existing management team and their commitment.
Absolutely. Their track record speaks for itself. They scaled the company from a mere £2 million initial investment to a peak market cap of over $580 million. That level of value creation is objectively market-beating, proving their M&A eye is unparalleled.
And their transparency has been key in maintaining trust during this downturn.
They're incredibly candid. Calling 2024 difficult and H1 2025 a mixed picture builds massive investor trust. They don't try to sugarcoat the impact of the U.S. funding cuts or the geotech delays. And finally, and this is a major signal in the context of the current low valuation, director alignment is extremely high.
How do we quantify that alignment?
Directors have been net purchasers of shares in 2025. Most notably, a non-executive director made a significant purchase in October 2025. When the people closest to the books, the insiders, are using their own cash to buy stock at these levels, it serves as a powerful validation signal. It suggests they believe the operational headwinds are temporary and the current valuation discount is excessive.
So for our listener tracking Judges Scientific, we've identified this dual reality: great structure, high risk. What are the 4 specific factors we must watch to determine if the bull case or the bear case is winning the argument?
Okay, number 1 remains the obvious, all-consuming factor: CEO succession. Any announcement detailing a credible, culturally aligned transition plan, especially naming a successor who understands and respects the decentralized discipline model, will immediately remove the key overhang and likely trigger a massive re-rating of the stock.
Second, proving the efficiency of the growth model still works at scale.
We have to track the aortic trajectory. Does it stabilize and recover toward 20%? If it continues its decline below the current 16.5%, it validates that structural concern that judges can no longer acquire high-return assets consistently. If it bounces back, the scalability risk recedes.
Third, proving the current operational weakness is cyclical, not structural.
We need to see the core organic growth rebound. Does the wider organic group return to that positive 8% growth? This would prove that the U.S. federal funding cuts and the China weakness were temporary cyclical blips and that the underlying niche moats remain robust and growing.
And finally, addressing the source of the recent volatility.
Commentary on the geotech contracts is essential for future predictability. Management needs to provide clear guidance on the timing and certainty of the next major coring expedition. They need to smooth out that lumpy revenue uncertainty for 2026 and beyond.
So, synthesizing this deep dive into Judges Scientific, we have a portrait of a uniquely positioned company. On one side, we find a 20-year history of rigorous, high-return compounding, proven cash generation, 122% conversion, even in a bad year, and a current stock valuation trading at a massive 40–50% discount to its peers. It's fundamentally a quality business trading cheaply.
But that historical success is undercut by these acute, high-stakes risks. You've got new earnings volatility introduced by the geotech pivot, quantitative evidence of efficiency challenges reflected in that sharp aortic decline, and the monumental concentrated strategic vacuum created by the imminent concurrent retirement of its founding CEO and his long-tenured team.
So for the long-term compounding investor, the bull thesis breaks if the CEO succession is fumbled. If it leads to strategic drift that sacrifices pricing discipline, or if the core organic weakness proves permanent, suggesting those niche moats are finally being eroded faster than anticipated.
Conversely, the bear thesis breaks, and that massive valuation gap closes if a clear, credible succession plan is announced and we see the ROTIC sustainably recover above 20%. That recovery would serve as quantitative proof that the M&A engine still works efficiently, even at this increased scale.
Okay, here's the provocative thought for you to carry forward. The competitive position of Judge's 25 underlying businesses, protected by those deep, narrow moats, is highly sustainable. These instruments are mission-critical, and the switching costs are immense. However, the sustainability of the growth model itself is now fundamentally at a crossroads because of that scalability versus returns trade-off and the looming leadership transition. The critical question for you to monitor is not whether the decentralized model works, it clearly does, but can the culture that enables this disciplined compounding survive its architect's departure?